Hello, my Apex family. It is March 2023, and I'm going to share with you some insight on how higher rates can benefit your buyers. So let's get started. What drives mortgage rates? Inflation. As we see here, inflation is starting to come down. Now, it's not coming down as quickly as we like, but eventually inflation will continue to drop and mortgage rates will continue to get to a more attractive level. Now, what's the holdup? Well, the holdup is shelter costs. They are lagging reports. What is shelter costs? This is the expense that includes rents. Let's take a look at what happens with shelter costs. As you can see, shelter costs went up dramatically in 2021 to peak in 2022. But as you can see, it's eased up significantly, and now we're at a 3% year over year. That is almost pre-COVID levels. The problem is when we look at how it measures, it counts 12 months in the rears. To add insult to injury, you go back to January 22 when the survey was reported. Example, a renter may have signed their lease in January of 2022 or prior. So that means the shelter costs can lag up to 18 months. As you know, that real time will eventually catch up. However, in the meantime, the way it is being reported on the CPI report, the Consumer Pricing Index, and especially the core CPI report, this will drive the direction of mortgage rates along with inflation. Now, some of you are asking, what does lag mean? We know that there is a lag in economic reports. An example is this roller coaster. The front of the roller coaster, or real shelter costs, are on their way down, but the shelter costs on the CPI report is still going up. Now, this is how it's being reported on the CPI report as opposed to real time. As you can see here on this thin blue line, that is the CPI report and how it's being reported. It's being reflected, still showing a lot of pressure on shelter costs and that it's still partially going up. That is an artificial push on the CPI report. Now, shelter costs make up about 43% of the CPI report. You can measure this difference between the two lines by using the calculation above, and you see the lag is about 5.5% as opposed to the real time at 3.5%. The point is that it will catch up and we will see the CPI report move lower, and it will allow mortgage rates to significantly lower levels. Now, what happens when mortgage rates start to drop? What will that do to the housing market? This illustrates the housing inventory on a national level since 1999, and currently it is really tight. People like to talk about a housing bubble. Well, when you take a look at when we were actually in a housing bubble in 2007, this certainly was a problem because there were too many homes and not enough buyers. In 2007, there was over 4 million homes available on the market. Today, there's only less than 1 million. Now, keep in mind, the population is growing and there's not enough homes for the current population. The bottom line is if mortgage rates do drop as projected and you see an increase in buyer activity, there is going to be an extremely tight inventory, and that spells multiple offers or upside down pricing pressure. So now, with less than 1 million units in existing home inventory that is currently being reported, what is not being shown is the 40% of those current homes under contract. So they're off the market. You can't buy those. So when we take a look at active listings and take that 40% away, that leaves a little over 500,000 homes that are currently active. So our population is growing to nearly 340 million people, but our active listings for homes is just a little over 500,000. That's slim pickings. So let's take a look at a comparative point of view. This is what active listings look like now, and this is a representation pre-COVID of a more normal market. Certainly home values went up during this normal market, but it really accelerated during low inventory. Here again in 2023, inventory has dropped even further. Now we don't expect rates to be like interest rates to be like 3% in 2021, but somewhere in the fives is where we hope to land very soon. And this should crank up demand quite a bit in a very low supply environment. So let's use this chart as an example of the opportunity that we have at this moment for our buyers. So look, we have seen home values increase over 10 years consecutively, 120 straight months of home values moving up. But in the second half of 2022, they came down modestly. It depends on the measurement that you look at. FHFA says 1%, and Case-Shiller says 2.7%. Now those are adjusted seasonally because the end of the year shows a little bit of a softer level of appreciation, but the year-over-year price are going up. Now, if rates do reach a level of where they start going down, home values will stop going down and start going up. So there will be a bottom in the very near future. Now let's assume none of us are good enough to pick the exact date of that bottom. And let's be resigned to the fact that we are going to miss that bottom. What do most people do? They wait till the bottom occurs. They wait for the all clear sign. Then they wait till home prices start going back up to see that it's starting to appear safe. The problem with that is sellers are going to see it too. They're going to feel more confident. There's going to be more competition. There's going to be multiple offers. So we are not going to see a good of a deal. The trick is to see the future before it's obvious. So if we realize that mortgage rates will drive demand in a very tight supply environment like now, as inflation starts coming down, mortgage rates will come down. What we want to do is to take this time while there's a little bit of a fear, a little bit of a weakness in the housing, and enter the market before the bottom, because sellers are going to be more fearful. Sellers will be more willing to give discounts or pay seller concessions. Even though the market is scarce with inventory, it does afford more choices. Then after the bottom, when more people enter the market, this will be the ideal time. So let's look at a case study. So if we look at this case study, at the last time we had a market bottom during that cycle, you can see prices were coming down, and the bottom hit around early 2012 before prices started moving higher. Notice the acceleration was much greater once we hit that bottom because people started entering the market and it really drove prices higher. In fact, the next year from that bottom, prices went up as much as 8%. That's 8% in 1 year. That's pretty robust. But inventory levels at the time in 2012 were at 2.4 million. Now, where we are at today in 2023, we're at less than 1 million. So far, fewer homes. Do we get a similar level of gain like we did in 2012, or do we see a greater increase in appreciation? That will be very difficult to forecast, but it would be safe to say that the prices will be supported of those values. Even in 2012, we had 2.4 million in inventory. We saw that 8% appreciation the next year. So let's be conservative in 2023 and say that there's only a 3% increase in appreciation. So what does this mean to your buyers? Let me provide you a real life example of a hypothetical loan that you actually use to purchase a home now. If you have a home value of $500,000, let's do simple math and let's just say you do a mortgage for $400,000. Now, at this time of the reports, rates are elevated. They are about 1% higher of where they have been recently. So that's a cost to people a little bit more. That keeps people a little bit more bashful in making offers on homes. So that monthly payment increase will be about $257. We multiply that by 12 year over year, that's $3,084. Now, that seems like a lot, but because we're in an environment where sellers are currently concerned and willing to negotiate a little bit more, and a lot of the negativity in the media may make it possible for, say, a discount off the sales price. We go back to those statistics and say anywhere between 1% and 3% discount off the current list price. Let's make it a solid number of $10,000. Remember, this is a hypothetical and there are other ways to negotiate, but let's use the 2% discount as an example. Now, as we hit bottom in the very near future, prices are going to start going up as interest rates go down, and sellers are going to have more confidence in their list price. Remember that last cycle bottom in 2012, the appreciation of home prices went up as much as 8%. Let's just say we're going to be conservative and they only go up 3%. So instead of getting a 2% discount, you get a 3% increase. You add that with the savings of that $10,000 in a discount, even though you might have a 1% higher mortgage rate, and we also do the charges for refinancing later, maybe as soon as 12 months from when you purchase the home. Let's do some round numbers, and voila, you end up coming up with a $20,000 benefit by not waiting for rates to go down. You end up getting the appreciation as home prices go up. You end up saving around 2% for the discount in the home. And even with the negative costs to the higher rate and refinancing at a later time, you're still at an increase on this example of around $20,000. Let's not wait. Share this with your clients. It takes a little longer to explain, but I like to have the data to back up my reasoning. Let me know if you have any questions or concerns. I appreciate your business.